He's known as the Bond King. Now his fund's ticker will also reflect that. Bill Gross's month-old Pimco ETF will now trade under the ticker symbol BOND, B-O-N-D. Here with us with more on that change and a whole lot more about the broader environment is Pimco founder Bill Gross. He joins us live from Newport Beach, California. Bill, welcome to In Business. Why the name change?
Well, it's just more easy to recognize, I guess, Margaret. I mean, I told my wife about it last night at the dinner table, and in the middle of the night she started saying something about James. I hope she was referring to the ETF, but you get the point.
That's how you're going to market it now, the new spokesperson, James Bond?
Well, no, but Bond is much more easily recognizable than TRXT, and in this business you want to go with a ticker and a sticker that people can recognize and pass on to their neighbors in terms of what to buy, and we hope this will be the case.
Well, I was looking at your commentary that you put out just yesterday, and at the tail end of the note, you warn investors to be extra wary of fees these days, management fees. Why is it that you noted that?
Well, I think we've noted that for a long time, and that's simply a cautionary element that suggests that when interest rates come down close to zero, and when the discounting of those interest rates in equity prices and other financial assets produce a prospective 4 to 5% total return for the combined asset classes, in our view, then it's incumbent upon a manager to keep expenses low and to alert investors as to the importance of expenses relative to lower returns in this new financial world that we speak to.
And when you look at the ETF product that you put out there, I mean, is that what is behind part of the appetite in looking beyond just the traditional mutual fund structure, looking more towards ETF products?
Well, I think so. We wanted to be able to give investors a choice. We recognize the tremendous importance of the retail distribution network for Pimco and for the Total Return Fund, which is now $253 billion. So thank you very much. We don't want to discourage that, but there are investors in the $10,000 to $20,000 category which find it difficult to buy Pimco Total Return, and we thought this would be a good way to do that in ETF space, actively managed ETFs. And by the way, outperforming the market in the first month or so of its early life by a good 200 basis points.
Well, we look, Bill, at the market this week. We've had $99 billion in issuance planned in terms of new securities put out there by the U.S. government. What kind of appetite do you have to buy?
Well, we have an average appetite in terms of duration space, and to the extent that 5-year treasuries, which are being issued today, and 7-year treasuries tomorrow, they reflect a relatively firm commitment on the part of Pimco, which reflects a relatively firm commitment on the part of the Fed that they will keep interest rates, firm until 2014, late 2014. Bernanke mentioned yesterday that wasn't a commitment in total, but it's subject to a relatively slow economy and contained inflation, which is what we see now. And so a 5-year security at slightly above 1%, to our way of thinking, as it rolls down the yield curve and becomes a 4-year, produces close to a 2% return. And is that, a super duper attractive type of return relative to history? No, it's not. But, relative to 25 basis point Treasury bills, it's certainly better than nothing.
And yet it seems, though, that you are backing away a bit from buying into Treasuries right now.
We've reduced our Treasury commitments slightly. From the standpoint of duration, we have average durations and average maturities across the board, but we've been reducing Treasuries and investing, yes, in shorter duration corporates to some extent, and rather heavily in the agency mortgage market. You can get, with a Fannie or a Freddie coupon that is a 4 or 4.5% coupon, you can really realize 3.5% as opposed to that 2% or 1% I mentioned in terms of 5-year space. So we're really focusing on spread and the lack of volatility going forward for the next 2 to 3 years, which is really the domain of 30-year and 15-year mortgages.
Living in a de-levering world. That's what Bill Gross is trying to do at Pimco right now. And Bill, it's really a challenge to find opportunity in this environment. When you say look more towards developing markets, what are the frontiers, the emerging markets that you find most attractive to buy into now?
Well, developing refers to higher growth as opposed to lower growth in the first place, Margaret. Secondly, where is that attractive growth? Countries like Brazil, countries in Asia, China related, of course. These countries don't come without risk. They don't come without a rather volatile situation in terms of inflation and currency disorder or potential currency disorder. But nonetheless, if an equity investor is looking for growth, you want to go developing as opposed to developed. And even a bond investor, if you're looking for higher real rates, such as in Brazil, you want to go to developing as opposed to developed.
And that Russian issuance of 5-year notes today, are you a buyer?
Yeah, we're looking at the 5-year, not the 10 and the 30. But I think at 230 basis points over the U.S. 5-year, that's an attractive situation. It doesn't come without risk. It's a BBB plus type of security in terms of sovereign space. It obviously has a history of default going 10 to 11 or 12 years back, but we think at these spreads and with the situation currently that it's an attractive situation compared to U.S. Treasuries.
You say it's important to be looking to try to buy hedges for fatter-tailed possibilities right now. What are some of those possibilities that you need to protect yourself against?
Well, on both sides, if we look at history in terms of a standard bell-shaped curve, the bell-shaped curve has thin tails. What we're suggesting now is not necessarily a extremely negative possibility. That would be the fat left tail, but also a fat right tail. I mean, we've had a fat right tail in equity markets for the past 3 to 6 months, a 10 to 15 to 20% appreciation, which isn't normal, which basically is bimodal, as we talk about. On the left-hand side, the bimodal possibility in terms of a downturn are simply a reflection of the high amount of leverage, the high degree of debt, and the policy coordination, which may or may not, be helpful in terms of, producing this smooth, rather bell-shaped mode or median that we're all used to.
Now, you talk about this run-up that you've seen in equities on the quarter and the like. Yeah, over the weekend, you took to Twitter and you posted your view that in April, in particular, we will see a sign from the Fed, from Ben Bernanke, that quantitative easing 3 may be rolled out. When Ben Bernanke looks at the stock market and the run-up we've seen, what do you think it signals to him? Why is it not more positive?
I think he's very satisfied. I think the Fed, Margaret, is outcomes oriented. They want an outcome in terms of a higher stock market. They should be satisfied, but they also want an outcome in terms of housing starts and lower unemployment. And what he said on Monday in terms of the employment picture basically suggested that up until now we've done very well in terms of reducing unemployment, but it'll be a tougher road to hoe going forward, if only because of structural impediments that he outlined. And so, going forward, he's looking at jobs, he's looking at unemployment, and he's looking at the housing market. And, future QEs, whether it's QE3 or an application of the current twist, to my way of thinking, will be an outcome-oriented type of strategy which seeks to provide jobs and provide, higher housing prices and housing starts to basically continue on.
What is the tool that you think he's going to deploy in April?
I have a sense that they'll continue with the twist, but not necessarily in terms of buying longer-term bonds and selling shorter-dated treasuries. I think that basically has been played out in that the pension market itself, in terms of their liability structure, has been damaged to some extent by lower 30-year yields. I think what he'll try to do is twist in the mortgage market, basically buy current coupon mortgages in agency space, 3s and 3.5s, and then basically twist twist by, repoing out the treasuries that they currently own in short-term space. So, a twist on another twist, I suppose, going forward.
Bill, it's an interesting conversation. Always great talking to you. Thank you so much for making time. We got to leave it right there.